Hello, this is Blaine McCormick from the Hand Camera School of Business with another video about the story behind the financial statements in the Foundation Business Simulation. This one deals with the income statement, which most participants understand pretty intuitively, but there are some intricacies with it, and so I thought I'd try to shed a little bit of light and put the income statement in context for the users of the Foundation Business Simulation. So let's start here. I realize here I just pulled an income statement from Fast Track, and statement just came out misspelled, so that's just kind of a clip from one of the Fast Tracks, so we'll just deal with that. But we'll compare two teams, Baldwin and Chester, and look at their income statements to tell the story here. And we'll start with this quote from Milton Friedman. It's kind of from one of his classic essays, and he said, "There's one and only one social responsibility of business: to use its resources, that's its balance sheet, or at least its assets, and engage in activities designed to increase its profits so long as it stays within the rules of the game." And so profit seems to be a very important word. Friedman would say the social responsibility of business is to increase its profits. Others would say the short-term goal of the business is to make a profit, and the income statement tells you whether you succeeded in that or not. And then Friedman also says you have to stay within the rules of the game. So that's certainly the law of the land and cultural ethical norms there. But also, some of those rules are generally accepted accounting principles, which is known as GAAP. And they tell you how to format your income statement so all income statements look alike. And they all kind of have the basic same shape here, and they all go by the same rules. And I'll just kind of throw a couple of those out here. One rule is that you can book your revenue or sales, but even though you've booked it, sometimes just one of the realities of income statements is that 30 days or more of sales are still in accounts receivable. If you sold on credit, you don't have that money yet, but you get to book the sales, and everybody understands that, and so that's just an acceptable rule, even though you haven't collected that sale. Or another rule is depreciation. You have to deduct wear and tear of your fixed assets as a non-cash expense off of your income statement or on your income statement. You have to do that. Foundation does it with 15-year straight line depreciation each year, and that's just one of the rules. You just have to do that. So that's kind of the rules of the game, and that kind of suggests that the income statement in some ways, not every way, but in some ways, is a scoreboard, and everybody agrees to play the great game of business and abide by these rules and keep score this way using generally accepted accounting principles. And that leaves a score at the bottom, and we can see that Baldwin scored lower than Chester in this game, and the income statement helps us understand why. It's kind of the play-by-play, so to speak, in understanding that. So let's take a look at the income statement and see what we can learn about why Chester outperformed Baldwin. So let's start with some basic nomenclature, just naming. At the top of the income statement is sales. This also goes by revenue, or a very common phrase, top line. So if people say we're growing our top line, we need to build our top line. That's what they mean. They want to grow revenue. And we can see that Baldwin had a better top line than Chester, and so that's good news for Baldwin there. We go down to the bottom, and that's known as the bottom line. We just said, what's your bottom line? That's where that phrase comes from, but it's your net profit or net income or earnings. It goes by many names, but they all mean basically the same thing in there. And we can see, even though Baldwin had a better top line than Chester, Chester actually had a better bottom line than Baldwin. And so that's kind of part of the story here, and understanding how that happened is part of the beauty of an income statement. It helps us understand that. And so income statements were developed to kind of be a scoreboard that everybody can understand. And I kind of think of them as this. I think of them as funnels. Your sales and revenue goes in up here at the top, and then your costs come out and your profits fall out the bottom here. And by and large, the bigger your top, or the bigger your top line, and the bigger the bottom of your funnel, the more profits will fall out of the bottom. But that's a different analogy there, but that might help you think through it just a little bit on there. So the name of the game between the top line and the bottom line is measuring and controlling costs, and all these things in this red box, not all of them, but there's one line that's not, but understanding what's inside that box and controlling it and minimizing your costs, or as some people would say, pulling out costs is part of the income statement exercise. This is what managers do, is they understand it and do it. So let's kind of go through it line by line and see what we've got here. So we've got our top line of sales there, and then our next line is variable costs. And that's also known as the costs of goods sold. On other income statements, label it that way. And if we subtract variable costs from sales, we get something called gross profit. And so we can take our sales and subtract our variable costs, and this gives us our gross profit. And we can already see that there's this explains a lot of the differences between Baldwin and Chester, in that it just cost Baldwin more to make their stuff, makes their products, and it costs Chester less to make their product, and so they already have a little bit of advantage in their gross profit here after subtracting their cost of goods sold. Well, how do you control costs here? Well, there's three costs in foundation that roll into your variable cost, and that's automation helps you minimize labor costs, and so that's how you drop labor costs. Lowering your MTBF, or your product reliability, helps you lower material costs. This has consequences in the marketplace, but it is one way to do that. Customers may not like you as a result, but it does help control costs. And then your carrying costs can be lowered through better forecasting, and so that takes care of your variable costs there. So if you forecast better, you automate, and you look at your product characteristics and don't give more MTBF than the market wants, you can minimize your variable cost, and it looks like Chester's doing a very good job of that. So let's go into the next part here and understand what's going on. The next section of the income statement is period costs, and these are costs that happen across a set period of time annually in foundation. These are your costs of doing business year to year, and that includes obviously depreciation, your SG&A, sales, general, and administrative expenses, and then some other things, fees for issuing bonds or stock, and your TQM investments each year and things like that. Those go into your period costs, and so that's the year-to-year cost of doing business there. And if we want to manage those, your depreciation is a 15-year straight line depreciation of your assets, which is about, you subtract about 6 2/3 of your fixed assets each year. You get as a non-cash expense on your income statement. So the smaller your fixed asset base, the smaller your depreciation. And so too many teams just have enormous fixed assets, or bigger than they need. They have more plant and equipment than they need, and if you can minimize your physical plant footprint, you can drop your depreciation, and that matters across the course of the simulation. Then to minimize your SG&A costs, you really just watch your R&D and your marketing costs. Just start paying attention on your R&D page when you invent something, how much this is costing you, and really on your marketing page when you're putting in your sales and your promo budgets. These $1 million there, $1 million here, it adds up pretty fast, and you can see the difference, the big difference here between SG&A between Baldwin and Chester. Here's another real advantage that Chester has. Not only do they have lower variable costs, they also have much lower SG&A costs in there, to the tune of about $5 million, and that's because they're just being a little more thrifty in that area. And then this last line here, the fees and things, that's just some of that's just the cost of doing business. But I would point to TQM. You can see that Chester put a lot more into TQM than Baldwin did, and they might be getting a really good benefit. You go, wow, they should stop investing in TQM. But if the benefit is good versus the cost, that can be a really good thing for Chester. And so that's a little bit about managing those costs there. So if we, again, start at our top line and subtract our variable cost, our depreciation, SG&A, our fees and other things, that gives us this line here. If you just get a calculator and subtract those out, it will equal this, and that's known as EBIT, or earnings before interest and taxes. Another phrase for this is operating profit, and this is just kind of, this part of the income statement captures your business model, so to speak, your operating model, irregardless of how you financed your business, which we'll get to in just a moment. But you can see that Chester is doing quite well here on their operating profit versus Baldwin, and so Chester looks really good at this point, and hopefully they'll stay that way in there. So let's look at the rest of the income statement and call it a lesson. Underneath your operating profit, or you have earnings before interest and taxes. Obviously, the last two things remaining are interest and taxes, and then we have some profit sharing that we go with there. And so your interest is the interest you pay on your long-term debt and your current debt, or your emergency loans if you took one in there. That goes into this interest line here. And you can see here's another advantage that Chester has. They're paying $1.6 million less interest than Baldwin. And so people issue bonds over and over again each round and think, this is free money, but it adds up. The interest starts becoming, $1 million here, $1 million there, and pretty soon other companies are out earning you. And here, taxes come out also from your operating profit. In Foundation, there's a 35% tax rate. And so you would look at your earnings before interest and taxes, take out your interests, and then 35% of that goes to pay your taxes. And so that's this line here. And because Chester's more profitable, they're paying more taxes there. And then you have some profit sharing down here, which you can't manipulate very much in Foundation. You just kind of share that per the labor contract. It's never very big money, but if you're really fanatical about controlling that, the fewer employees you have, the less profit you share. And that can help you there, although I don't think that's a real line to focus on too much. That's not going to swing it one way or another. The other costs are a little bit more important there. And so that gives us the full income statement. If we start at our top line and subtract everything out and look here at our operating profit, that's one stop. And then we take out how we financed. If we financed with debt, we take out all of our debt. If you never use debt or you've paid off all your debt, that line disappears. Then we pay our taxes, we share our profits, and that gives us our net profit there at the bottom, our bottom line. And you can see that Chester, even though they sold less, because they controlled their variable cost and their period costs better, they've done a little bit better on interest, they have a better bottom line than Baldwin does. And that's good news for Chester. Hooray for them. So that's the scoreboard. Both Chester and Baldwin play by the same set of rules in Foundation. They keep score the same way. The good news is Foundation automatically does everything for your income statement and shares it with you in there. And we say in our class that profit is a matter of opinion, but cash is a matter of fact. Because this is just rules. For example, you've sold, you can book these sales, but 30 days of those sales are still in accounts payable, and that's a lot of cash in there. And your depreciation is a non-cash expense, and so that's cash kind of back in your pocket there. And so the big question is at the end of the income statement, do I have any cash? And where's my cash going? And that's a question that you answer on the cash flow statement, and so that will be a different lesson.